Hello, everybody. Good morning. This is our update for episode 159 on June 22nd of DAT's IQ Freight Market Update. I'm Dean Croak here at DAT Freight and Analytics, sitting in for Ken Adamo today, who's in hospital with his wife. They've just had their third child, Forrest Ryan Adamo, this morning. Congratulations to the Adamos. I hope they're not watching. And as always, I'm joined with Ned Damon, who's our principal data scientist and recent returnee to the office environment. Good morning, Ned.
Good morning, Dean. How you doing?
I'm great. How's it being back in the office?
So the shine wore off after the first couple of days. Like the first 2 days, it was magical. Right. I had a nice dedicated space to work in. There was coffee. I had to make the coffee, but there was break room coffee. Right. But by Friday, just the meetings. There's a lot less threshold to have meetings. Strangely enough, when you're in the office. So
yeah, it was my first week back traveling. I was in the Denver office last week, so it was kind of strange. It was weird to be traveling again. Lots of non-business travelers out there. Planes are packed. Most everybody was pretty civil, so it was good to be back, but unusual being back in the office environment. I did notice there was a noticeable hustle out there in the workplace. The Denver peak hour traffic from 3 till 7 p.m. was back. It's a 4-hour event, so people were complaining about that. People still haven't got their driving legs under them. They're still a little bit distracted, so. And of course, up your way, you've got the Olympic track and field qualifiers underway at the new Hayward Field in Eugene. That's a pretty big event in the Pacific Northwest. Yeah. The other thing I've noticed is a lot of sporting events are opening up, which has sort of been my benchmark for society getting back to normal. We've got Euro 2020, we've got football on, Stanley Cup, NBA Finals this month, British Open. Tour de France starts this Saturday, which is a huge global event. We've got the Olympic Games in July, so. Things are getting back to business pretty quickly, which is rather exciting. Today, you might not know, Ned, today is also the 3-month anniversary of the Ever Given getting stuck sideways in the Suez Canal.
Ooh.
Yeah, 91 days today, it got stuck for 6 days. It's still being held hostage by the Suez Canal Authority. Their initial demand was $916 million for salvage costs and reputational and other damages. I just read today that the court case is delayed a couple of weeks, so hopefully that gets resolved and those sailors and mariners on board get to go home soon and some of those containers get delivered. All right, so let's get back to the US trucking market. For those new to the program, we're here every Tuesday at 10 a.m. Eastern, 7 a.m. Pacific, talking about what's happening in freight, but most importantly, to answer your questions. Ned will be handling those in the background, so feel free to drop those questions in the chat section below. We'll get to them. Things tend to pile up towards the end, so remember, get your questions in early. We've got a crew in the background working to get those over to us as quickly as possible so we can answer them on air. And of course, if we don't, you can find our written version of the show at dat.com market update, which gets published on Tuesday. So let's jump right into the week in freight and start with some of the key trends that we're watching. This week is Amazon Prime Day. I think we're in the second day right now. News this morning was very interesting. A lot of sellers were very worried they'll run out of stock due to supply chain shortages. Some of them are very worried about offering discounts and not having stock for Christmas. All of this has implications for back to school season, which starts next week. That is happening way too soon, just as we're starting the summer vacation period. On the spot rate front, there was almost zero change in spot rates last week, which was kind of strange because if you have a look at our year-over-year data, the period between Memorial Day and Independence Day is what we call grilling season. We normally see a surge in spot rates. There's a higher demand, especially if you're refrigerated, but rates have been bouncing off this ceiling for about 5 to 6 weeks. So it looks like that peak we see around July 4 may not eventuate this month. Of course, yesterday was the official start of summer. We're already 3 weeks into the hurricane season, which is surprising. We've already had 3 named storms. Claudette wreaked havoc over the weekend in Alabama, causing numerous fatalities. NOAA's predicting another above-average hurricane season. We had tornadoes just south of Chicago this week, record heat with many states across the West at risk of electricity shortages. Because of the extreme drought, it's crimping the amount of water used for generate hydro power, which is a dominant source of energy out west. So there's some of the things we're watching. On the dry van load board front, let's take a look at what we're seeing in that market today. Load post volumes increased again last week by just under 7% week over week. And that's just ahead of this week's Amazon Prime Day shopping event. So there's a lot of activity in the dry van spaces. Retailers were stocking up. Load post volumes are up 33% year over year. but have been trending downwards. I think that's important to note that volumes in the spot market have been slowly declining. They're now down 5% month over month. So equipment posts last week were back up slightly. So as a result, the load to truck ratio shifted up to 5.17 loads per truck. In the refrigerated sector, there was a bit of a surge in reefer volumes last week, as you would expect, as retailers and consumers begin to stock up for July 4 celebrations. We'll cover that on next week's show, where we'll cover how many truckloads of freight are required to deliver everything for July 4. Last week, load post volumes jumped 14% week over week, and along with 7% fewer equipment posts, the load to truck ratio increased to 11.11. In flatbed, volumes dropped 10% week over week. They're now down 20% month over month. And as you can see, tracking almost identically with 2018, which is one of the more bizarre charts that I've seen in my time, given that they were two very different economies, 18 versus 21. There was very little change in equipment posts last week. So the flatbed load to truck ratio dropped from 73.6 to 65.49. It's a long way south of where it was a few weeks ago at 100 loads per truck. In the dry van market condition index, in the top 10 markets, they represent a quarter of our load post volumes. Volumes were down 2%, but there are only two markets that posted positive gains last week, and it's no surprise which two they were. Following import volumes of containers in May being up 14% in Long Beach and 22% in Los Angeles, spot market volumes were up 5% week over week in Ontario, and that's where the majority of import containers end up and being transloaded into road and rail units. In Ontario, capacity was tight again last week, as it is in a lot of the West Coast markets. Spot rates moved up 3 cents a mile to $3.23. And in Los Angeles, rates are up again, only by 1 cent a mile to $3.10 per mile. That's excluding fuel. And on the e-commerce lane from Los Angeles to Phoenix, it's only a 372-mile run. It's a tight run to do a round trip in a day, but it's doable. Rates are up to $4.32 a mile on that run today. That's 30 cents a mile higher than last year's peak in November. It's also $1.77 a mile higher since February this year. So if you do the math, it's about $2.33 a mile round trip for carriers and a lot of them are just turning and burning in Phoenix and not even looking for a backhaul to get back to Los Angeles to move that freight off the ports. In refrigerated, top 10 load post volumes increased 4% week over week, but like dry van, rates plateaued. The spot rates in the top 10 increased by 2 cents a mile to $3.16. Atlanta to Miami, 664 miles. Rates are up to $3.32 a mile last week. They've been averaging about $3.30 a mile since last September, but they're up about 30 cents a mile in the last 4 weeks, which coincides with the end of produce season in lower southern Florida. Just up the road in Lakeland, spot volumes dropped 9% week over week and capacity loosened quickly. Rates dropped 13 cents a mile to $2.01. In California, reefer capacity was tight again, even on lower week over week reefer volumes. Ontario volumes were down 9%, but spot rates headed in the other direction. They were up 2 cents a mile to an average of $3.69, excluding fuel to all destinations. Just north in Fresno, spot rates remained unchanged at $3.36 a mile on 6% lower week over week volumes. And in the flatbed area, you can see lots of red there on the chart. Capacity is still very tight. Although there is some signs that there is a little bit of easing. It's hard to get a read on this market. Load post volumes were down 13% last week. Spot rates, though, on the average in the top 10 markets only averaged a drop of 1 cent a mile, still historically high at $3.64. In the logistics hub in the center of the country in Memphis, even though volumes remained unchanged, capacity tightened. Spot rates are up 6 cents a mile to an average of $3.63. And in Savannah, that's the nation's #1 port for exports in the country. Volumes, despite outbound volumes decreasing 22% week over week, capacity was very tight in flatbed. Spot rates jumped 15 cents a mile to an average of $3.67. So wrapping up with our year over year view of spot rates, dry van spot rates remained flat last week compared to prior week, staying around $2.36 a mile excluding fuel, still 72 cents a mile higher than this time last year and about 33 cents a mile higher than 18. Taking a look at the refrigerated sector, spot rates stayed at the same level like also last week. They ended at $2.70 a mile, still at all-time record high heading into the July 4 season. still 79 cents a mile higher than this time last year and 36 cents a mile higher than 18. And lastly, taking a look at our flatbed market, flatbed spot rates continue to plateau around this 270 per mile mark. This is the 5th week in a row where spot rates have been working in this tight band, up 1 cent per mile one week, down 1 cent per mile the next. Haven't had a lot of movement the last 6 to 7 weeks. They tend to be bouncing off this ceiling, just like refrigerated rates are. Volumes are clearly declining though in flatbed. There's a real sense this sector is cooling off after an amazing run in the last 12 months. They're still 81 cents a mile higher than this week last year and about 24 cents a mile higher than the same time in 2018. So that's it for this week's market update. If you'd like to find out more about what's happening in freight, go to dat.com market update and download our weekly report. So that's it for the market update. Over to you, Ned, for the short-term forecast.
Howdy, everybody. So we're going to be starting off with our dry van forecast. You can see in blue the market rates observed by DAT. And then off to the right, you can see a bunch of our different forecast models. In green is our flagship ratecast model. In red is our short-term model. That is a little bit more aggressive about responding to changes in the marketplace, but also has a lot less anchoring and tends to go one way and the other. And then in gold and silver are our two blended forecasts, which are mixtures of these two models in different amounts and in different ways. So the short-term model is starting to chicken little a little bit. I expect that there is going to be some drop as we move into the post 4th of July. You can see that the ratecast model is expecting things to come down as well as the short term, but the short term is really expecting things to just start sliding from here on out, whereas ratecast is expecting a little bit of pickup as we head right before 4th of July, although the short term does expect a little more of the pop on the 4th. Moving on to reefer. Once again, you can see in blue is the market rates observed by DAT. And then off to the right are in red the short-term model, in green the ratecast model, and in gold and silver the blended forecast in different amounts, which are mixtures of the two models in different amounts and in different ways. For this set of models, there's a lot of disagreement early on. Ratecast is expecting rates to pick back up heading into the 4th and then decay back down, while the short-term model is expecting just a pop around the 4th of July and a slow, steady slide. But they're both in agreement that rates are probably going to be dropping as we head into the back half of July. Finally, moving into the flatbed space. Once again, in blue, we have the rates observed by DAT in the market. And then off to the right, we've got the short-term model in red, the ratecast model in green, and the blended forecast in gold and silver. And here, there's just broad model agreement. They're expecting things to stay more or less flat. Ratecast is expecting the 4th of July peak to be spread out a little bit, whereas the short-term model is expecting a little pop there. But overall, I think that flatbed is expecting things to keep in that band that Dean's been talking about, the little narrow window. And that's it for our short-term forecast. Now, I believe it is time for our Ask IQ question of the week, the text of which I am about to pull up. One moment. Sorry, wrong text. What is the outlook for retail sales? Dean.
Yeah, this is an interesting one. I was reading a report that Jason Miller pushed out over the weekend on LinkedIn. He'll have some more data out today on retail sales. And of course, we had some interesting numbers on durable goods orders last month. Last week, it was clear that we'd had that pivot that many had been talking about from goods to services. Last week, we saw a drop in durable goods in May of 1.3%. What was interesting was that consumers trimmed expenditure on automobiles, furniture, electronics, even in building materials. Lots of delays in getting goods, so there was a downturn there. But the flip side was that consumer spending on services increased in May. That was up 1.8%. So building materials and garden supplies down 6%. But consumer spending on restaurant and bars heading in the other direction. Even health and personal care goods increased 1.8%. So it certainly looks like we've had that pivot at a macroeconomic level from goods back to services. There's some supply chain disruptions that are impacting that. And of course, Ned, it's Amazon Prime Day / week because all of the big box retailers get in on the act this week to follow suit. So I was listening to the news this morning and reading in Washington Post that A lot of the third-party resellers are pulling back this year. They haven't been able to meet the discount requirements that Amazon require. So what's happening is that they're also worried about, they're opting out, firstly, but because they're worried about shortages and the need to keep inventory for Christmas. So the big concern this year around Amazon Prime Day and other big box retailer events is the impact the pandemic has had on supply chains. They're still grappling with widespread supply chain disruptions and having enough inventory, let alone being able to offer a decent discount to attract buyers. So
yeah,
it was kind of interesting. The National Retail Federation also said this week that 2/3 of their members have added 2 to 3 weeks to their supply chain. So I'm not sure that this big event this week will be what it normally is. There's a much bigger supply chain issue at play here.
No, I mean, I agree with that. And then to add in, like you were saying, because of the shift from goods to services, I know I've ordered about as much stuff off the internet as I care to for a fair bit. And, I'm not necessarily the bellwether. If the deals are good enough, I'm sure that people will go. But I think what you were saying exactly about the fact that for a lot of retailers, the issue isn't moving volume. The issue is making margin, right? Like the input costs are up in a lot of fields. And, the supply chain costs are just up. So they're going to be more worried about making margin with the inventory they have than trying to move huge amounts of inventory.
Yep. And it's coming to the fore today. But of course, on the other side of the ocean, you've got, the port of Yanshan is just back to 70% capacity following the COVID outbreak there. So you've got this supply chain ripple effect happening, globally. So those ships that are leaving there 3 to 4 weeks out, that's when they do leave there. So you've got a lot of volume of containers still either not on ships being rolled over from ship to ship due to very tight capacity. A great example was I talked to my local bicycle shop this morning, and they've got 240 new bikes on order. So they've already pre-sold them. It's no different than a lot of other industries, I'm sure. But the timeline for the delivery of the 240 bikes is October, which of course is way past summer.
Yeah.
A lot of people need the bike. So I think there's a lot of businesses in that position where it's not so much demand, it's the supply side that's really constraining the ability to meet that demand. And I just wonder, Ned, at what point do people, does demand fall away because we've got so much inflationary pressure on prices and the inability to get goods? Do people just say, what, I'm just not going to worry about buying those things?
I mean, I think that you're seeing that in some sectors, like housing starts, for example. I know that a lot of people are delaying or just canceling projects that they had for home improvement and renovation, given the cost of materials. And I know for some things you can get pretty rapid supply adjustments, or at least in regular normal times, you can get pretty aggressive supply adjustments. But in a lot of sectors, you just can't. I mean, look at the semiconductor market, right? Like where that's really holding a lot of other sectors hostage because that's that key input. And there's no way to spin up more production in anything like a reasonable amount of time.
Yeah, the building industry is interesting. Last week we had the Census Bureau push out the May data for single family housing starts. And it was kind of interesting. This is on top of the price of lumber, that bubble that we saw in the price of lumber being up around $1,700 per 1,000 board feet, now down under, well under 1,000, but up a long way from the $300 per 1,000 board feet it was this time last year. But new home starts are up 4% in May, and that's interesting. So they're up 34% year over year. So we built just over 1 million new single family homes in May, and for context, that's 44,000 more than compared to April last year. So we've built a lot more homes. There's still a lot of demand, but building permits were down nearly 2%. And I think that's important because building permits are an indicator that there's a slowdown on the way. Permits tend to lead home starts by a couple of months. So that could be an indicator that future flatbed demand for lumber and building materials is going to start to taper off. Of course, retail prices are still pretty high because a lot of the big retailers have purchased lumber prices at those very high levels. But there is a sign that it's starting to cool down. And I did notice yesterday that some of the builders are just, pulling off from building homes. They may have laid the slab. Some are even putting in escalation clauses into contracts to guarantee that they won't be caught short when prices rise, and that's having a dampening effect on the new home market from what we hear from the National Association of Home Builders.
Yeah. Do you think? I think we're ready to do some questions.
Sure.
We've got one from Matt Clark. You said, Dean, you said produce season was winding down. When do you see the holiday season starting?
Produce season's winding down in Florida was for context. So we typically see the peak in produce volumes in terms of meaningful volumes is May. So once we get to the end of May, the heat really starts to ramp up, and we see produce volumes out of the southern part of the country start to die off. We're now starting to see healthy volumes of blueberries and blackberries in New Jersey, so it's kind of the middle latitudes of the country. We've got cherry season starting out in the Pacific Northwest. So produce season is still well underway. We haven't hit the peak just there yet, but holiday season I think is starting now in terms of both demand and on the shortage side. Once news start to spread that we are looking at Christmas retail inventory shortages in June, that tells me that the holiday season is going to be a pretty long event this year.
Yeah, I mean, I think that for my guess is, given the delay in the supply chain, for a lot of retailers, you just need to start preparing well in advance. So like trying to shift the bulk of it as much as you can is probably going to be a move that's made. Boyan asks, what's the dry van forecast? So broad model agreement that there's going to be leaning towards down in the later part of July, some disagreement in the late part of June, early part of July. Short term thinks that things are going down with a blip around July 4th. Ratecast is expecting a little bit more of a smooth up and then down, with a rise of maybe a couple of cents up to 5 cents heading into the 4th of July. And then slowly heading down to converge with the short term. That looks like it's about it for the questions. Do we want to just fill air for 2 minutes?
I did have a question that I wanted to ask, and I was going to ask it during the forecast for reefers, Ned.
Yeah.
We've had spot rates at record high. I went back and looked at our spot rates for the last 10 years and compared to the contract. We haven't seen anything like this. And what has struck me has been this ceiling that rates reached in the reefer market at about $270 a mile, excluding fuel. So they've sort of been bouncing off this $270 a mile ceiling for the last 5 to 6 weeks, sort of oscillating up and down week over week. And I do remember us on a show quite a few weeks ago sort of hypothesizing that we may not see the typical July 4 peak. And I just wanted to sort of maybe talk about that ceiling that we see and some of the factors that drive that, because anecdotally we heard shippers talk to us about inability to take on higher transportation costs because they have a reduced ability to pass on those costs in the B2B environment. So it's looking more and more like the peak that we see historically around July 4 won't eventuate this year.
Yeah, I mean, Ratecast isn't expecting like a big peak. Neither is the short term. Neither model is expecting anything more than like a little blip right around the holiday. But normally the July 4th is much more pronounced. And I think you're absolutely right that there are these upper bounds on what shippers are willing to tolerate. And, if once you're already in the red zone, you stomping on the accelerator more isn't going to make the car go any faster.
Right. We've still got the supply side constraints in terms of, pay rises bringing meaningful driver numbers back into the marketplace. There's still just a general labour constraint. Our whole workforce has changed, though. We've now got a workforce that can sustain itself working from home a couple of days a week. We've got a lot more pressure on regional and short haul, driver businesses for demand. So I think the long haul sector is going to be capacity constrained for some time. And that's sort of that puts some upward pressure on spot rates, inflationary pressure over time. But there seems to be some resistance for rates going much higher historically than where they are right now. Now that said, we're heading into hurricane season. We've got another big break. It's a driver safety week. The FMCSA are having another week-long event in July 11th. So in 3 weeks' time, we're going to see another week-long event where the authorities are going to focus on risky driving behaviours. That's for trucks and cars, but we could see some sort of a capacity impact. Timing is interesting this year, though, because that happens right after the short work week following Independence Day. And I wonder about what sort of impacts that'll have on capacity, given that drivers will be taking time off over that week anyway, and will they extend it beyond that week into that week to avoid the traps of losing hours, if not half a day, maybe more in inspection locations.
I think we got time for one more question from Stephen Linton. What do you guys see with diesel in the near and long term?
Yeah, that's a great question.
It's hard.
Yeah. I'm just pulling up that diesel prices right now. It's $3.29 per day. Per gallon. That's up substantially from $2.39 where they were back in October. Stephen, I'm not an expert on diesel prices other than being a big consumer of diesel with my own truck. The normal inflationary trends through summer is there. It's evident right now. So I think there's more upward pressure on rates per gallon than there is deflationary pressure right now. That's a normal seasonal trend that we see each year. So I think as manufacturers in the refineries start to come back online and sell more of the barrel in terms of jet fuel and petroleum, that'll decrease the inventory levels of diesel, and that'll put more pressure on price. So I think that's definitely the consensus, is more upward pressure on diesel.
Yeah, and given the hurricane season where a lot of the U.S. refining capacity is, there is an outside risk that there's going to be a rough period.
Right. Yeah, above average season.
Yeah.
We saw the impact on that already this week in New Orleans and Mobile, Alabama, where there was an increase in volumes in readiness for the big storm that hit this weekend.
All right. Do we want to do any shout outs before we close it out?
Yeah, sure. The Freightvine show was absolutely fascinating. The latest podcast. We had Chris Kaplis had Stephen Judge on from Newell Brands. Newell Brands are the people behind Rubbermaid and Yankee Candle and some of those big consumer brands. Great conversation, great podcast about what Stephen's been doing at Newell Brands in terms of reducing the number of lanes in his routing guide and how they've been managing the costs of transportation and procurement during the pandemic. It's a great show, well worth listening to.
And then can we talk about Dr. Kaplis being on next week?
Well, sure. Yeah, he's confirmed.
Yeah. Oh, excellent. Okay. Yeah. So I'm out next week, but he'll be in, and then one of the other DAT data scientists we're going to be letting out of the cave to see the light of day for a little bit.
Yeah. All right. Well, that's it for this week. I'll do a quick wrap. If you've got any questions, hit us up at askiq@dat.com. That email hits all of our inboxes. We'll get to those quickly. Don't forget our weekly update at dat.com/market update. Don't forget Chris Kaplis' Freightvine podcast, a great listen this week in particular. Again, Safe Driver Week comes up on July 11. Keep that in your calendar. That could have an impact. And that's really about all we have this week. We'll see you again next Tuesday at 10 a.m. We hope you all have a great rest of the week. Thanks for watching.